Hi, my name's Brian Albrich. I am a retirement mortgage specialist and senior vice president of the reverse team here at Fairway Home Mortgage. And today I am going to share some information about reverse mortgage loans. Just a little bit about myself. In 2002, I got into the residential mortgage business and never maybe did one reverse mortgage for the first 18, 16 years of my career. In 2018, I had the opportunity to take a class and it was all taught from a financial planning perspective on reverse mortgages. It was almost a week long. And so, anyway, I left there thinking this loan is amazing. As a matter of fact, it seems too good to be true. So I actually went on my journey to explore and verify the facts of this loan product before I went and talked to anybody about it. So today we're going to go over some of those facts and the reason why I got into it, and hopefully it brings some peace of mind or awareness of this product to you so you can consider it for your own financial plan or retirement. So here we go. What you're going to learn today, we're going to introduce introduction to reverse mortgages, what it takes to qualify, and the different loan options, how you can use the reverse mortgage, what happens at loan maturity, and why Fairway. Okay, introduction to reverse mortgages. If we were in the same room together, I would ask you this question. Uh, what is your opinion of reverse mortgages? Well, recently, folks that have gotten these may have a really good positive feedback. In the past years and in decades, maybe not so much. I've heard some bad things about them, and so I'm here just to learn the facts. It's pretty interesting. There's a lot of outdated information, a lot of myths about what may or may not be factual with reverses. Some actually maybe were factual years ago, but have been fixed over the years. All right. Well, if you're over 55 and concerned about the following subjects, market volatility and inflation, maybe you're concerned about outliving your savings, concerned about making monthly mortgage payments during retirement, or not being able to continue to live in your home in a safe and sustainable way. Well, if any of these apply to you, then a reverse mortgage could be the solution. So let's explore. First of all, what is a reverse mortgage? Well, it's a loan exclusively for older adults. It requires no monthly mortgage payment. The borrower does have to pay property taxes, HOA dues, insurance, and upkeep of the home. What it does is converts home equity into cash or a line of credit to be used. And the neat thing about these is there's no payment required. So unlike maybe a remodel loan or a HELOC where you go get it to maybe improve your bathroom or whatever, you don't have a payment on it like those scenarios. So, and then repayment is deferred until the borrower sells, moves out, or passes away. So, what is a home equity conversion mortgage or HECM? For whatever reason, FHA decided to name the reverse mortgage a HECM. And again, what that stands for is converting some of the home equity into usable cash or a line of credit. It's exclusively for those 62 and better. Now, you only need one person in the household that's 62. You can have somebody that's younger than 62. They still remain on title. Now, that wasn't always the case. And that's one of the big myths that's still out there is I hear all the time you can lose your house. Well, back in the day when somebody would get one of these, if the person, one of the partners or spouse was under 62, they had to be removed from title, which is a big problem. If the older spouse dies, they're not on title. they could lose the house. That's been fixed. So it's federally insured. It started in 1989. So in 1989, they originally came up with this program to keep some seniors in their homes. And then it's morphed since then. Back then they didn't know everything that they didn't know. So there's been a lot of things that originally started out. They thought was okay, and then they realized, for example, taking one of the spouses off titles not a good thing. So that's been fixed. There's been a lot of other things that have been addressed and fixed over the years. FHA is continually refining and strengthening the borrower safeguards, and we'll go over some of those here in a slide to come. The most used reverse mortgage in the US is the HECM reverse. I would say 95% plus is the FHA HECM program. There are other reverse mortgages that are very nichey, and for the right people, they can be a really good solution. So we're going to go over those a little bit as well today, too. Um, Here we are. What are proprietary reverse mortgages? Proprietary is a non-FHA loan. It's a private reverse mortgage. It's investor owned versus insured by FHA. They cater to older adults who, now you only need to be 55 or older. So with this one, you can borrow on a higher home value against a higher home value than the FHA product. You can live in a non FHA approved condo complex, for example, with this product. Again, younger than 62 down to 55. So you only need one person in the household that's 55 or older. And there are some lesser fees because of it's not FHA, so there's no upfront mortgage insurance, which saves some upfront closing costs. I hear all the time, aren't reverse mortgages just a loan of last resort? Well, no, and the math backs that up. Today's reverse mortgages have wide appeal, including among affluent older adults, and it's actually there's been some extremely smart retirement academics that have proven the math that even highly affluent people do better with the reverse mortgage. Here's the thought, and the math backs this up: is yes, you may have less equity when you pass away or move, but it's been proven that all of the other retirement assets have generally done better because, for example, you don't have to draw them down during a downturn in the market because you could draw from the reverse mortgage. So we'll go over that in a little more detail. Primary reason folks get a reverse mortgage, they have a need to address an urgent need like paying for in-home care, lifestyle enhancement to pay for things not in the budget like travel. I've done these for folks. I had a guy cry at the end. He couldn't travel out of state more than once a year to see his best friend, which was in the state over. With this, he was able to do that. And he also said he was able to take his wife out to dinner more often. So that's lifestyle enhancement. Financial planning to maximize cash flow, reduce taxes, and minimize risk. Because this is a loan, it doesn't affect your tax standing. So, for example, if you draw X amount a month for a certain amount of time, it doesn't take you into the next tax bracket if you're using it to supplement your income, which is a really nice feature. HECM reverse mortgage key advantages: flexibility and control. Again, there's no required monthly payment during as long as you live in the home. So now you can make payments. We'll go over that maybe a little more in detail later, but there's no required payment. You're converting home equity into cash. You can choose your payout options. You can do a lump sum, you can do a line of credit, or you can do a monthly draw. You can fund things like care, in-home care, home upgrades, vacations. You keep ownership in your home. So that's one of the biggest misnomers out there is that if you get a reverse mortgage, the bank or the government's going to take your house. And that's not true. you're the only one on title, just like with a regular mortgage. It is FHA non-recourse, meaning FHA guarantees you and the bank and your beneficiaries that nobody is on the hook for anything owed and be above and beyond what the house is worth when you move out. It's an amazing feature. You could literally owe $1 million on a house that because we're in a major economic catastrophe and your house is only worth 100,000. FHA forgives everything above and beyond that 100,000. So it's a very powerful tool. The line of credit growth. This is an amazing thing too. The line of credit, whatever the unused portion of your reverse mortgage sits in a line of credit, that line of credit grows over time at your note rate. So even if your home value goes down, your line of credit continues to expand, even to the point where the line of credit can exceed the value of the home. Um, Pretty safe. And they're generally easier to qualify to because you don't have a principal and interest payment. And the underwriters, they're FHA underwriters. This is a manual underwrite, meaning they really dig into these and they look at the actual person. And they use a residual income factor versus a debt to income factor that is used with a traditional mortgage. Key considerations. You know the trade-offs. Loan balance grows over time. So the loan balance does compound over time. But as I mentioned, and the reason why I do these is because the math proves that even though your balance on the reverse grows over time, your other assets may have grown as well because you're not tapping them. So there's always a trade-off. Home equity is reduced. Again, home equity might be less home equity when you move out of the home, but you might have more in your 401k, in your IRA. They're higher upfront costs than a traditional mortgage, but you got to look what you're getting. So this isn't a traditional mortgage. So when people say these are too expensive, well, compared to what? I've heard it mentioned that, excuse me, the insurance on these is really insuring your income. So yeah, it's a mortgage, but it's also insuring against a loss of income. So there are some benefits, and in many cases, it's worth every penny because it's a game changer for folks. All right. Well, some of the reverse mortgage myths that I'd like to address and hopefully debunk. One myth is that the bank. I hear all the time, the bank will own the home, or the government is going to own the home. I lose my ownership, and that's just absolutely not true. The fact is, you keep full ownership and title to your home. So if you want to do a remodel, you want to upgrade your bathroom, you want to dig in your backyard, it's your house. You get to do with it whatever you want. The lender simply holds a lien against your home, just like with a traditional 30-year fixed mortgage. You can sell, refinance, or pass down the home at any time. Myth number two, you can't have a mortgage and still qualify. Not true. The fact is, an existing mortgage can be paid off with your reverse mortgage proceeds. Now, you have to have enough equity to do that. Let's say you owe 200,000 on a $600,000 home. There's most likely, depending on your age, going to be enough to pay that off. Now, if you owe 200,000 on a $300,000 home, there's not enough equity to pay it off. So there needs to be enough equity. But if there's enough equity, whatever that percentage is that you're allowed to borrow based on your age, you can pay off any existing mortgages, and it is like a huge pay raise. I just did one the other day. They're paying about $2,500 a month on their traditional mortgage. We're paying that off, and they're getting a pay raise of about $30,000 by being able to do that. So you absolutely can do that. Whatever's left over comes to you in a line of credit. But if there are any liens, those get paid off first, including the regular mortgage. Myth number three: the heirs will be stuck with a big bill. Again, It's non-recourse, meaning nobody owes anything above and beyond what the home is worth. So you or your heirs will never owe more than the home's value after the loan matures and the home is sold. So again, if the house is only worth 100,000, and let's say the house you owe 500,000 because you've had the reverse mortgage for 60 years, nobody's on the hook. You just walk away. Okay, top HECM consumer protections. So these are protections that FHA is put into place to make sure that the consumers are protected. These all didn't necessarily weren't available when this loan first came out, and then over the years they learned that there are certain things that they need to do to make sure that the borrower is protected. So one is mandatory counseling. It ensures the understanding before applying. So if you're getting a reverse mortgage, you have to do counseling before we can proceed with the process, and it's a neutral third party vetted by FHA. There's cross-selling protections. It's so you can't be convinced by a lender and maybe a financial planner to pull money out of your house to go buy an annuity, for example. You can't do that. Initial disbursement limits, that's to keep folks that, you always hear about people that win the lottery and in a few years are completely broke. This is kind of this disbursement limit's kind of the same thing. They don't want you to pull all your money out right away because they want to make sure that there's an understanding of how it works and that you don't go on a worldwide vacation for 3 years and run out of your HECM, and then you don't have money to pay for your obligations like taxes and homeowners insurance. There's a credit and income review. They want to confirm you have long-term stability, sustainability. So they want to make sure that you pay your bills on time and that it's important for you to pay your bills on time. There's protections for the non-borrowing spouse. I talked about this earlier. They used to, the non-borrowing spouse is the person that's not eligible age-wise if they're under 62. Before, in the past, years ago, the younger spouse had to be removed from title if they weren't 62. That's been fixed. They're on title. If the older spouse passes away, the younger spouse, even though they weren't on the loan, they're on title and they can stay in the house until they pass away, and they still don't have to make a mortgage payment either, which is really cool. The HECM line of credit is guaranteed. It's guaranteed access even if the home value goes down, and it has that built-in growth. And again, the non-recourse feature, meaning nobody is on the hook for anything owed above and beyond what your house is worth when you move out of the house. All right, well, here's a little fun with play on the Three Little Pigs, which we all are familiar with from our childhoods. In this case, we have the three little piggy banks, and we're going to take a look at the piggy banks of our retirement. So, piggy bank number one is monthly income, traditional monthly income. In retirement, we have Social Security, pension, annuity, and wage income if you're still working. Piggy bank number two, we have it's the nest egg. So it's you're drawing down on things like a 401k, stocks, bonds, CD savings, and IRAs. Now, the big bad wolf over there in the corner, he's the retirement risks. You have inflation, you have stock market volatility, healthcare needs, spending surprises, and longevity risks is what financial advisors like to call it. Now, piggy bank number three, the big orange one, is home equity. We're going to talk a little bit about how home equity can protect piggy banks number one and two. You have what it provides you is access to tax-free cash for home equity to address some of those risks. Um, Building a sturdy retirement with piggy bank number three, the HECM can help you boost cash flow, reduce retirement risks by providing you an extra bucket of liquid money that can be used as needed, even in an emergency. And it helps preserve your nest egg, coordinated draws from equity, and the nest egg. So And again, this is one of the reasons why I got into this field of residential lending and focus just on reverses. Is because folks like Dr. Wade Pfau and Dr. Barry Sachs have proven the math that shows having a non-correlated asset outside of what you have invested in your traditional retirement accounts helps keep those alive longer. So thus the sustainability and protecting against longevity risk. So again, playing off the three little pigs, it helps you happily helps your retirement live happily ever after. So here's one of the gentlemen I spoke about, Dr. Wade Pfau. You have to ask yourself, why wouldn't you get a reverse mortgage? Dr. Pfau, in his book, says use strategically, a reverse mortgage can greatly improve the sustainability of your retirement income. Again, I'm not just shooting from the hip on these. These are PhD level folks that have done the math and proven that other retirement assets generally do better, which helps your retirement do better with coordinating it with a reverse mortgage. So let's talk about the qualifications and options that the way you can use the reverse mortgage. Who qualifies for a HECM? One homeowner needs to be 62 or older. You can be married to a 52-year-old. You just have to have one person that's 62 or older. You need sufficient credit, income, and home equity. And you must live and maintain in the home. So now you don't have to live there all year. You can live there half a year in one day, basically. It's got to be the place where you file your taxes every year. You can travel, you can do all that kind of stuff. It just has to be your primary residence. What are the eligible property types for a reverse mortgage? Well, any property that can be financed by FHA. So just like a 30-year fixed FHA loan, FHA determines what type of homes that you can borrow against. And so we have single family residences. That's obviously the most typical. We can do a 2 to 4 unit property. Here's the cool thing about that. If you found a duplex in your retirement and you lived on one side of it, you could get a reverse mortgage so you don't have a mortgage payment. You could rent out the other side, and that could be an income stream for you. So that's a pretty cool option. You can do it on a townhome. Now you can get a reverse on a condo in a HUD approved condo project. All condo projects need to be approved by HUD to get one of these. Now, sometimes the entire project is not approvable, but sometimes you can get a single unit out of that project approved. We actually have a full team of people that specialize in just that, working with HOAs to see if they can get condo projects approved. Now, I mentioned proprietary reverses earlier. Sometimes we have to look at one of those if we can't do FHA. Plan unit developments, no problem. Modular homes, no problem. And what surprises a lot of people, we can actually do these on a manufactured home. It just has to be FHA approved, and that's in 1976, June of 1976 is when FHA started stamping manufactured homes as approved for financing. Now, equity is a key thing. I wish we could do more of these reverses for folks, but you do need quite a bit of equity in the home. But for the right people, it's a game changer. So typically need 50 to 75% equity in your home to qualify. Now, equity meaning what's left over after loans are paid off. So in this case, we have a $400,000 home. They have a mortgage of 100. So home equity in this case, they have 300,000. So that is that. How can you take a reverse mortgage loan proceeds? Well, you can take it in several different ways and even a combination of them. So, number one, single disbursement, you can take a lump sum. Now, if you have a mortgage, current mortgage on your house, your lump sum could pay that off, for example. If you don't owe anything on your home, or you have a big line of credit left over after paying any mortgages that you might have, you can do fixed monthly advances, Or you can just do a line of credit. And again, that line of credit grows over time at whatever your note rate is. And the final option, you can do a combination of all three. So let's say you do a lump sum to pay off a small mortgage. You can do that. And you can do, if there's enough line of credit, you can do fixed monthly advances for X amount of years. And then whatever's left over, you have a line of credit for an emergency down the road. Okay, well, in this section, we're going to discuss the different ways you can use a reverse mortgage. At the end of the day, you can use it for whatever you want to use it for. So, but let's go into some details here. As a reminder, we've got the power of the HECM line of credit. It's growing. You can leave the unused proceeds in a line of credit. So, as I mentioned, that line of credit will always grow, even if your home value goes down. The line of credit is determined originally based on the home value as determined by an appraiser when you get the loan. After that, the loan or your home can go down to worth $1, and if you have a $200,000 line of credit, you can still use it. It's incredible. So unlike a traditional HELOC, the HECM also can't be capped, frozen, or canceled even in down market downturns. Now, in 2008, that a lot of people had a home equity line of credit as their backup plan. And what happened was, even if they were making their payments on time, even if they didn't even have a balance, those could be frozen, and they can still be frozen. And so, what was going to be used as a backup emergency bucket for people that might lose their jobs during a recession or whatever, they got frozen and they didn't have access to them, which is a huge problem, as you might imagine. The HECM, the FHA reverse HECM, can never be frozen, even in a market downturn. So, extremely safe feature. Again, it provides stable, secure financial flexibility, built-in safety net that strengthens over time. So, this if your intention is to stay in the home long term until you can't get around in that home anymore, why wouldn't you want to get that line of credit that just sits there and grows? Because my thought is, how much is too much to have available to you if things hit the fan? Whether it's a health emergency, a house emergency, that financial markets tank in half, which has happened before. Why not have this extra bucket to be able to tap? And as a reminder, when you draw from it, there's no payments required until you move out of the house. So extremely valuable. So I more talking about how that line of credit grows. The unused funds grow at a compounding rate equal to the loan's current interest rate plus FHA's annual mortgage insurance premium of a 0.5%. So that if you have a loan balance, your note rate plus that 0.5% make your balance grow. But what's left over on the line of credit is also growing at that rate. And as a reminder, even if your home value is going down, so it's just an extremely powerful tool to have available to you. The growth compounds monthly. The longer the funds remain untouched, the larger the future borrowing power. So again, it's just kind of a let you sleep better at night feature of this product. So here's an example of the HECM line of credit. Somebody has a $500,000 home. They qualify for a $200,000 initial line of credit, interest rate of 6.75 and 2% annual home appreciation. So in year zero, meaning the day you get the loan, you get your $200,000 line of credit and the home value is 500. In 5 years, that line of credit's grown to 287. The home value is at 552 now. After 10, line of credit is 412. Home value is 610. Look at this. After 20 years, that line of credit is 849,000, even though the home value is only 743. So if stuff hit the fan after 20 years, or let's say you want to move, and maybe you're not moving into assisted living, maybe you're just moving into a different house, maybe you're 82 after getting one of these at 62, and you still want to you want to live in a nice place, and so you could take that 849 and put it as a down payment on your next house. So pretty powerful. Way sooner may be smarter. Waiting longer doesn't always mean accessing more equity. Some people say, oh, I'm going to wait till I get older and then I can get more equity, but they forget about the compounding effect. So borrower's principal limit, the principal limit, meaning the loan to value, is based on the age of the youngest borrower, the expected interest rate, and to the lesser of the home value or the HECM lending limit. Now, it's in 2026, it's just under 1.25 million. So a little bit more than this, but this still applies. That's how they determine. They look at your age, age of the youngest borrower, current interest rates, and the value of the home, and they say, okay, here's what you get. Here's the percentage of the home that you get to borrow against. More on why, getting these sooner rather than later, um, because you're sacrificing the compounding growth of that line of credit. Establishing a line of credit lets growth compound over time, even if no funds are drawn. Again, it just continues to grow behind the scenes. But if you need it, it's there. You draw it. As a matter of fact, this is kind of interesting. Uh, it's not a credit card like with a HELOC or whatever. You actually, there's a draw request. You do. And FHA or your servicer has 5 business days to get it into your account. So, if you needed, say, $10,000 to fix the roof, you put in the draw. 5 days later, it just gets deposited right into your checking or savings account. And then in a raising rate environment, the line of credit is growing. So most, I would say 90+%, probably higher than that, is people choose the adjustable option versus the fixed. The fixed is an option, but it doesn't let you borrow as much, and it makes you draw whatever is available all on day one. So you're accumulating interest on the full drawn amount on day one, whereas the line of credit, you only accumulate interest on what you draw over time. So that's an important thing. And on top of that, because the again the line of credit grows over time, you can far exceed the borrowing power with the adjustable over the fixed product. Common uses of the HECM. Now, financial advisors talk about aging in place, and that's really what the FHA HECM is for. It's for folks to stay in the home that they want to be in for as long as they want to be there. You can eliminate your monthly mortgage payment, like we talked about. You can pay off a current mortgage. So if you have enough equity, you can pay that off, and then you might get a raise of $20,000 a year if your payments are, close to $2,000 a month. That goes away because you refinanced it into the reverse mortgage. You can use the loan proceeds to refinance, like I said, into traditional mortgage, into a reverse. Um, you can improve monthly cash flow uh, just by getting rid of the mortgage. So, like I said, you can improve your cash flow by whatever your monthly mortgage payment is. But if there's anything left over, you can still draw monthly from a line of credit as well. So, kind of a double whammy for the good in that scenario. You can do home improvements, fund repairs, renovations, make accessibility upgrades. And again, this by using this, and as I talked about earlier, you're preserving your other accounts. You're not having to draw down your other retirement accounts to make these fixes or upgrades, or even you don't have to go get a loan and then make monthly payments because the loan on this, there's no monthly payments required. Okay, well, some of the common uses of a reverse mortgage, when FHA put these together, the idea is to help seniors stay in their home until they want to move out. They're not forced to move out because of expenses and so forth. So, in the financial planning community, they call it aging in place. And that's really what the reverse is for. So, improvement of cash flow is a big thing that the reverse provides. One of the biggest things that, and I love it when we're able to do this, if there's enough equity in the home, we can pay off a current mortgage, use those loan proceeds from the reverse to refinance a traditional mortgage into a reverse. So let's say somebody has $2,500 a month principal and interest payment on their current mortgage. If we pay that off and refinance it into a reverse, that's like a $30,000 a year pay raise to somebody. And then, not only does it improve the cash flow, it reduces financial stress. And, I did one of these just recently where the couple had owed about $200,000. He was a little bit older and he was worried if he passed that because she would lose access to his pension, that she wouldn't be able to afford the house. So they were going to move or rent or whatever. Well, we were able to pay that mortgage off, knowing that, when her income goes down, if he passes first, she still doesn't have a mortgage payment. So that's a really cool safety feature. And then home improvements and accessibility, you can fund repairs or renovations to age safely and comfortably. Maybe you're remodeling bathrooms, widening doorways for a wheelchair or whatever. And that finally, you're avoiding draining savings to do this. So there's nothing worse than trying to cobble together either by draining savings or then going out and getting a loan for the remodel and then having payments on that. So then you're draining savings slowly over time versus just tap the reverse mortgage, pay for it, and not have a payment that's not due until you actually move out of the home. Refinance example number one. Here's a case study where somebody pays off their existing mortgage to improve the monthly cash flow. The cost of living expenses have risen and they're just struggling to make ends meet. This client is 82. They have a home that's 688,000 and they have a current small mortgage left. They've been making payments for years, but they still owe 40,000 and their monthly payment's $480. At closing, they requested $23,000, and that was because they were cobbling things together that they weren't able to keep up with their expenses with their fixed income, and so they were catching up by drawing $23,000 initially with the reverse to pay off some credit card debt that they had used to just get by. And then in addition to that, they're going to do $2,500 a month draw for the next 5 years. All said and done, they still have a line of credit of 119,000 left over. So let's take a look at what that would look like. We have our disbursement in year one. You have closing costs and pay off the mortgage and the cash out, but you're still left with that line of credit of $119,000, and you that continues to grow over time, even with these draws of $30,000. So after say 5 years, in year six, they still have access to a line of credit of $182,000. So pretty powerful stuff. Common uses of the HECM continued here. Care and caring. It's said that close to 65-70% of those over 65 need some type of long-term care. Um, so you can pay for long-term care insurance premiums and proactively, or you can actually pay for long-term care, the reverse mortgage. So, and there's a lot of people that don't qualify for long-term care. Maybe they're already sick. Maybe they've had a heart problem. Maybe they've had a stroke. They might not qualify for long-term care. Well, if they have a reverse line of credit, they can pay for their long-term care out of their pocket if and when it's needed. So, again, they can cover nursing home deposits or in-home care costs. They can fund medical bills or unexpected health expenses. And then, there's some fun things that you can do with it too. You can help a loved one. You can help your grandkids pay tuition, or maybe help your grandkids or your kids on their own home purchase. They call it gifting with a warm hand. That's just, instead of gifting when you're already passed away, this allows somebody to maybe pre give their inheritance while they're still alive to actually get to enjoy handing that gift to their family member. And then, some people, maybe they don't have a family, or maybe they have a family, but they also want to give charitable gifting. They can do that as well. And again, because there's no payment required, if they draw from the line of credit to do that gift, uh, there's no financial burden of a payment to do that. So it's a pretty cool feature. Now the average cost of long-term care is insanely high, like all healthcare. But look at this: home healthcare. It averages nationwide about $78,000, and this is already a year old, so it's probably higher than that. That's for things like Alzheimer care, meal prep, diet monitoring, light housekeeping errands, etc. Assisted living facility. What if there's a couple and somebody needs to move into an assisted living facility? That's about $71,000 a year. As a reminder, the just requires one person to remain in the primary residence, and so if one of the partners or spouse needed to move out and get some additional care, one can move out and the other can draw from the line of credit as long as they remain in the home. And nursing home care, that's almost $128,000. That's for full-time in-care facility, advanced long-term care therapy, and skilled nursing. Again, if one of the couple borrowers is still in the home, they can draw that line of credit to help pay for their loved one that's in the facility. Again, we're talking about costs. Average long-term care, Medicaid only pays for shared rooms. Most people don't know that. You hear a lot, oh, I'm going to just let Medicaid take care of it. Unfortunately, Medicaid doesn't cover a whole lot, and you only get a shared room. And believe it or not, 95% of people have no long term care insurance. When this says 50% will need long term care, it's actually closer to 70 from articles I've read. So most people end up needing it, or a big majority. Why not have? If like I said, a lot of people don't qualify for long term care, or maybe they can't afford it. So you could use the reverse line of credit to either pay for the insurance premiums to get it, or if you're not able to qualify for long-term care, use the line of credit to actually pay for the long-term care need items, just directly from the line of credit. And we've talked a lot about healthcare and those things that just don't sound fun. But you also have lifestyle and life changes. You can use this to enhance your retirement cash flow, increase monthly flexibility for travel, hobbies, or your family expenses. Maybe the family likes to go to the beach once a year and the grandparents want to pay it. They could use this. So just an idea. And then divorce and estate planning. Unfortunately, even seniors get divorced, and I think it's like 9% of people over 65 actually get divorced. You could actually draw get a reverse mortgage, draw to pay off the departing spouse from the home, and then they could use that money as a down payment to purchase their house with the reverse mortgage. So potentially both uh, parties of a couple divorce could get a reverse mortgage and not have a mortgage payment during their retirement years. Okay, for our second case study, this senior has decided to get a reverse to improve their cash flow. They had an IRA that was only going to last a few more months due to costs incurred for caring for her mother. This is common. You see this where people have some kind of healthcare event or some kind of emergency, and they spend down their retirement accounts, and then they're stuck. They really don't know what to do, and reverse can help solve that. So, in this case, this client is 79. She's in a $748,000 home, and she has no liens or mortgages against the property. In her case, she's going to set up a $3,000 a month draw for 7 years, and left over, she's going to have a line of credit of 121,812, and she's going to draw $15,000 at closing. See this all the time. People have been cobbling together, just trying to get by, drawing from credit cards and so forth. So she's going to pay those off with that initial draw, so she doesn't have that monthly expense. Now, here's what it looks like. So there's her initial draw, and here's her line of credit, and then she's drawing $3,000 a month for 7 years. But even so, after 7 years, In year 8, she still has a $201,000 line of credit. So if she wanted to stay there, she can. If she wants to move, she can draw that $201,000 line of credit, and that can be her down payment for maybe she's downsizing, or maybe she's moving into some kind of assisted living, or maybe she's going to live with her family, but she's got 201,000 she could put in her bank account while she's waiting to sell her home to get by. So it gives her options, many different options, which is really what that line of credit does. It's really an amazing feature, that growing line of credit that can help boost retirement income or just fill in the gaps. So, our third example here of different uses of the reverse mortgage is enhancing a already sound retirement plan. Can do debt consolidation, pay off higher interest debts like credit cards and loans, like we've talked about. Can enhance monthly cash flow. You can either enhance it by paying off a current mortgage that you have. So just by getting rid of that mortgage payment is a huge boost for some people. But you can also draw monthly off of this if there's a remaining line of credit after you pay off any mortgages that you might have. Again, market protection, used as a buffer during market downturns, and this is where the math from folks like Dr. Wade Pfau and Dr. Barry Sachs have proven that um, as those assets are depleted, are diminished in the retirement accounts, you can use the reverse to complement or even use it completely, rather than drawing down those accounts while they're diminished. Because once you've drawn down and sold at a loss from your retirement accounts, it's so hard for them to recover. It's called sequence of returns risk, meaning selling at a loss, they just never recover. So you might run out of money earlier. So having a non-correlated asset not tied to what the market's doing it's a huge boost sometimes. Um, and then last but not least, using as an emergency fund, drawing the line of credit for unexpected expenses, whether it's a house expense, a car expense, or a health expense. And then key financial planning advantages, drawing part of the monthly cash flow tax free from your home. So, as a reminder, it doesn't put you into the next tax bracket if you're drawing, say, fixed income from Social Security or pension. Supplementing that with the reverse mortgage draw is not going to put you into the next tax bracket. So that's really cool. And then the primary financial planning advantage of a reverse mortgage isn't just cash flow, it's the growing line of credit that we've talked about several times. But it is really like I've said, even if the home value goes down, the that line of credit continues to grow and it's there as needed. Did you know that you can actually buy a home with a reverse mortgage? It's a pretty cool feature. Now, all the lending requirements are the same. They determine how much you can borrow based on your age and the current market conditions. But I've mentioned earlier that the reverse mortgage originally came out in 1989, and FHA discovered that you know, in the years to follow, people were buying a home, maybe paying cash or getting a traditional mortgage, and then turning around right away, and getting the reverse because they liked the fact that they wouldn't have a mortgage payment. So in 2009, FHA approved the ability to just, instead of having to refinance, you could just actually buy the home. So, people can upsize, downsize, or right size into the ideal home, move closer to grandkids or hospitals or amenities, whatever those may be. So, for as little as 45 to 70% of the purchase price down, you can get a reverse purchase. Generally people are selling a home that they've been in for a lot of years. Maybe that house has deferred maintenance. Maybe it was too big because that was the house that the family was in, and people want to, just start fresh. So the idea being with the reverse purchases, You could keep more of your retirement assets to use as you wish instead of having to pay all cash for a home. Maybe you put, like I said, 45 to 70% down, the rest on the reverse. And then maybe you have some funds left over from the sale of that previous home to put in a savings account or some kind of interest bearing account that can be used to keep you liquid. And so you're not house poor. So it just like a regular mortgage or regular reverse mortgage, there's no required monthly payments. You do have to pay property charges like taxes and HOAs and so forth. So here's an example. Somebody right sizing. Um, Sue is 73. She nets 300,000 from selling her home, and she wants to buy a $400,000 home. She could pay all cash. So, but on the $400,000 home, but that means she only has 300 from the sale of her previous home, so she has to go, draw 100,000 from, say, her retirement account. So there's that, she has less in her retirement account now by doing that. Or she can make up the difference, getting a traditional mortgage. She puts the 300 down, and now she goes and gets a 30-year fix. But with that comes a payment of $1,900 a month, which is almost $24,000 a year that she's drawing down from her other retirement accounts to pay for that mortgage. Or she could do the HECM for purchase. She only needs to put 225,000 down. That means she has 75,000 left over that she could put in her bank, which she can use to maybe decorate her house or just live off of. But by putting 225 down, the other 175 is a reverse mortgage with no payment. So it's really kind of a cool feature. Now, what happens when folks pass away or move out of the home? The maturity event um, with the reverse mortgage, and what causes the maturity event? Well, if you sell your home, you have to pay off that reverse mortgage. If you transfer title to somebody, you need to pay it off. If the last surviving borrower moves out permanently, then the loan is due. Or if there's a default on any of the loan terms. For example, what if somebody stops paying their property taxes? Well, the county's going to put a lien against the property, which creates a foreclosure event. Now, the last surviving borrower passes away. That also they pass away. Let's say that last survivor passed, and the family that receives the home in the will or the trust has a year to decide whether they want to either move into the home themselves or they can sell it. So those are the options for the family. Now, how is the loan balance repaid? Well, you can actually make voluntary payments, and there's some really cool it creates some really cool opportunities by being able to make payments. So what if somebody said, I just cannot stand the fact that even though I'm not required to make payments, the interest is accruing over time? What if they're still working and they say pay $2,000 a month to their reverse mortgage? Well, after a year, that's $24,000. And the neat thing about making a payment with the reverse is dollar for dollar, it makes your line of credit grow. So that just made their line of credit grow by $24,000. What if you need it next year? What if an unexpected emergency happens? You can actually pull all of it back out. So, unlike a regular mortgage, if you pay extra, it's stuck. Now, with this, it's liquid and you can just draw it back out. Or you can do no monthly mortgage payments and just pay it off when one of those maturity events that we just talked about happens. Um, like I said, if any of those events happen, the loan is due and payable. Usually, the loan is satisfied via selling the home. But as a reminder, the HECMs are non-recourse. So if the folks owe more than their house is worth at the time of the maturity event, nobody's on the hook. Um, your heirs can never owe more than your home is worth at the time of maturity. So that's a huge safety feature. Okay, what happens when mom or dad pass away and leave the home? What are the options for the heirs? Now, if the heirs want the home and there's equity left in the home, then they just pay off the current mortgage and with either cash or their own mortgage, and then they just get the house. They just pay off what's owed, and the house is theirs. Now, if the parents owe more than their house is worth, this is a really cool feature, and they want to keep the home. They're only responsible for 95% of current market value based on an appraisal at that time. So let's just use real simple math. Let's say the parents owe 200,000 and the house is only worth 90 or 100,000. So the kids would only need to come up with 95%, which is 95,000 of the current market value, whether it's their own loan or or cash. The other 105,000 in that case, because the parents owed 200, is forgiven by FHA. So it's a really cool feature. Now, if they want to get rid of the home and there's equity left over, they can sell the home and just pocket any profits. So let's say the house is worth 500, the parents owe 200, they sell for five, pay off the two, and the remaining 300,000 is theirs. Now, if there's no equity in the home and the kids just don't want the home, it's nowhere where they want to live and so forth, they just do a sign. They sign a deed in lieu of foreclosure and just walk away from the home. The bank actually has to deal with selling the home at that case. So again, nobody's on the hook. You just let the bank sell it and you just be on your way. Why Fairway? Well, I like to say that it's because I'm here, but we are a very, we will just. Well, if you've made it this far through the webinar, thank you so much for joining me today. As a reminder, I'm Brian Albrich, and I'm a senior vice president with the reverse division here at Fairway Home Mortgage, and also a retirement mortgage specialist. That just means I'm the licensed individual that works with the consumers to get reverse mortgages. And all of my contact information is here. And I am based in Bend, Oregon, but licensed in most of the states west of the Rockies, including Arizona, California, Hawaii, Idaho, Montana, Nevada, of course, Oregon, Utah, and Washington. So if I can be of assistance in any of those states, please reach out. And I do have colleagues that are fellow reverse mortgage specialists throughout the United States with Fairway and can put you in touch with one of them if needed. So anyway, thanks again and hope you found some value in this presentation today. All right, take care.